Hey YouTube, Matthew Decker here, Leveraged Wealth. I hope that you're doing well today. Today is normally a Takedown Thursday, but I've got a bunch of policy reviews kind of running over in the studio. So I'm actually back in my office, and I've been getting a bunch of questions the last probably 3 months about indexed universal life insurance policies and the caps and rates. And so that's what I wanted to talk about today, just to kind of provide some context on how these different companies set their caps, what can affect caps, and really what you need to be paying attention to moving forward. So the first thing that we have to talk about when we talk about indexed universal life insurance policy caps is that caps are revenue neutral. Now, at least they should be. Okay, so if you're working with an A-rated carrier that is doing their best to pass along as much value as possible, the caps that they set are going to be revenue neutral. Now, what I mean by that is they are not making money on setting your caps. And so sometimes I hear things along the lines of, my caps were reduced, the company is just trying to take that profit or something along those lines. And that's not really what's happening. The reason that caps are revenue neutral is simply how they are set. And so all of these insurance companies have what's called a general portfolio. So it's a simple portfolio of basically investment grade bonds. And they hold those bonds to maturity. They don't really trade them, but they've been investing in those bonds for the last 15, 20, 30 years. Now that general portfolio throws off interest. And right now, most general portfolios on indexed universal life insurance policies are generating anywhere from 4 to 5%. And so how these companies end up setting their caps and rates looks like this. All these policies, they will have a fixed account. And so if you've ever seen an indexed universal life insurance policy, they almost all have fixed accounts. Now what's interesting is the fixed accounts are almost going to mirror the general portfolio rate of return. So whatever the company is earning on its general portfolio, just to make it easy, they're essentially passing those earnings on to you in the form of the fixed account or the fixed rate. Now the fixed rate is declared annually. The reason the fixed rate is declared annually is because the general portfolio fluctuates in its rate of return. You have a bunch of little policy holders, thousands and thousands of IUL policy holders that are all funneling money every single year into the general portfolio in the form of premiums. Okay, so you have the thousands and thousands of policies on the books paying premiums every single year into the general portfolio. That's where those funds go. Okay, so once the funds get there, what do? Well, they reinvest those funds in bonds. And since they're reinvesting those funds in bonds, they're investing those dollars at today's interest rates. Now that's important because where are interest rates right now? Well, they're about as low as they've ever been. And so as all this money gets added every single year into the general portfolio, and as the general portfolio of the insurance company invests at today's interest rates, if interest rates are low, it will drag down the yield of their portfolio. If interest rates are high, it will boost the yield on their general portfolio. And that's why your fixed account is declared annually, because the rate that the general portfolio is generating changes every single year based on where interest rates are today. Okay, so why is all that important? Had to set all of that up because when you go to, let me just clear this away so it's easier to see. When you go to invest in your indexed universal life insurance policy, so let's assume this is your indexed universal life insurance policy, you're going to see the fixed account, and let's just say the fixed account's paying 4%. You're going to see the fixed account, and then you're going to see a bunch of other indexed options below that fixed account, and they're either going to have a cap or they're going to have a spread or a participation rate. Okay, so these are all just different ways to determine how your interest is going to be earned on this index. Let's keep it super simple. Let's assume that you only have two other options aside from the fixed account in this policy. And let's assume that it is AG, which is just the iShares US Aggregate Bond Index. And let's say that the cap on AG is, I don't know, 20%. Okay, so it's a 20% cap. I'm making up these numbers. And let's say that the other one that you can invest in, or you can allocate the money to, is the S&P, SPY. And let's say that the cap is 10%. Okay, totally making up these numbers, right? This product doesn't exist. I'm making it up. So what's happening every single year is the company is actually coming to you and they're saying, okay, Mr. and Mrs. Policyholder, you have a decision. We're now in year 5 of the contract, and we would like to know, do you want to invest your money in the fixed account? If you do, we will pay you 4%. So what they're really asking you is, do you want 4% fixed for the year? Now, what do most people say? They say, no, I don't want this 4% fixed rate for the year. You know, the reason that I got into this index universal life insurance policy is because, you know, I want a little bit larger return. You know, I'd like to earn kind of these indexed returns. So I don't want the fixed rate. And the company says, hey, no problem at all. If you don't want the fixed rate, you know, choose one of these index options below. We've got AG available for you, and we've got SPY. AG has a 20% cap. SPY has a 10% cap. Now, from here, I'd like to pause because I want to pose a question to you. What do you think the life insurance company wants you to choose? What do they want you to choose? Of these 3 options, which one do they want you to choose? The fixed account paying 4%, where you know exactly what you're going to earn. AG, which is a bond fund, U.S. Aggregate Bond Fund. It's got a really high cap, but you know it's a bond fund. It's probably not going to perform at 20% because it's a bond fund. And then you've got the S&P. It's got a 10% cap, but you know it's highly volatile, and so there is a good chance that you get a 10% return. In fact, you're probably going to cap out something like 7 years out of 10 or 6 years out of 10 maybe in the S&P index, simply because it's a very volatile index. What do you think the company wants you to choose? The answer is the company does not care at all. In fact, if you were to give the company a crystal ball and the company knew which of these options was going to generate the highest rate of return. So let's say at the end, let's say the company does have a crystal ball, all right, and they know what these indexes are going to perform at the end of the year. So obviously the fixed account's going to pay 4 because that's what it pays. It's a stated rate. Let's say that AG is going to perform at 8%, and let's pay SPY, let's change that actually. Let's say that AG is going to perform at 5%, and SPY is going to perform at 9%. Okay, if they have a crystal ball, which one of these index options does the company want you to invest in? Which one? Do they want you to earn 4, 5, or 9? Now, what's interesting is a lot of people who don't understand these products would say, well, if the company is going to pay me, 4, 5, or 9, they'd rather pay me 4. Because paying me 5 or 9 means I make more, which means the company makes less. Wrong. That's not how it works. See, the company, if they could choose, if they had a crystal ball and they could choose, they would say, well, we want you fully invested in the S&P because the S&P index is going to give you a 9% return, and that 9% return is the highest rate of return that we got for the year, and that's what we want you to get. Now, why in the world would the company choose the one that's going to give you the highest rate of return when the company's the one giving you the returns? Well, the answer is crucial if you're going to understand indexed universal life insurance policies. And the reason that the answer is crucial is because it all has to do with how these policies are priced and how the returns are generated. And so if you remember, we have that general portfolio that's generating between 4 to 5%, right? And you have that fixed rate, so that equals, in this case, that fixed rate at 4% is what we said. And so what the company is actually doing is when they come to you with that decision of how you want to allocate your dollars for the year, do you want the fixed rate or not? That's essentially what they're saying. If you don't choose the fixed rate, all the company is doing is they're saying, well, you don't want the fixed rate? No big deal. We were already going to pay you 4%. And since we were already going to pay you 4%, whatever that dollar amount is, so let's say you've got $100,000 in this account, at 4%, it's $4,000. Okay, so we were already on the hook to pay you $4,000. Since you don't want the fixed rate, all the company's going to do is they're going to take that $4,000 and they're going to go down to one of these two other index options, SPY or AG, and they're going to say, okay, well, we've got $4,000 to hedge SPY or AG with. What can we buy this customer in the form of a cap so that we can max out their potential return? And if we've got $4,000 to spend on SPY, just, we'll give you some real numbers here. SPY, so I'm looking here today, this is, May 20th. So last year, a year ago, May 20th, SPY was at 296. Today, it's at 414. Okay, so that's a huge spread. Let's look at AG real quick. AG a year ago today was at 117, and today it's at 114. Okay, but the chart looks like this. Well, the reason it doesn't look like that. It actually looks like, let me do a better representation. The chart looks like this, but it's only moved 3 points. Okay, so AG is not volatile at all. And so what this means, this gets into volatility. S&P, highly volatile, huge swings. I mean, we're talking about over 100-point swing in SPY, major swings, okay? AG, not very volatile at all. It's moved 3 points in a year. So if you have $4,000 to spend, one of the biggest drivers of hedging, and hedging is how they generate these returns, and if you want to learn more about hedging, you can certainly do that. There's a lot of good explainer videos on hedging. But if you've got $4,000 to spend, one of the biggest drivers of what you can purchase is volatility. And that's why a SPY index, the S&P index, being highly volatile, maybe they can only buy you a 10% cap with $4,000. In AG, they can probably buy you an uncapped index, but we said 20%, so we'll just stick with it. They can buy you a 20% cap because it's so much less volatile. And volatility drives the price of these options contracts that generate the returns on these policies. So this brings me to my next point, which is, well, there's really no benefit in having an AG index on an indexed contract when it's not really moving much. You can't really eke out much return there. And having a huge cap on a bond index doesn't really make much sense, right? It just doesn't. The reason it doesn't make sense is because you're never going to get 20% in an AG index. And so why spend the money for a 20% cap? So what these companies are doing, because they realize that volatility is an issue, right? They want you to win because it costs them the same amount. They're spending this 4%, whether you choose the fixed rate, whether you choose SPY, whether you choose AG, NASDAQ, Dow, blended index, fancy index, rainbow index. It doesn't matter. They're spending the exact same amount of dollars. And so they want you to get the highest return possible. And that's why a lot of these companies are moving to blended options. Okay, so blended index options where maybe there's an SPY component and maybe there's an AG component. And what they're actually doing is they're moving money, let's make this easier, they're moving money back and forth between the S&P and AG daily based on volatility. So as the market is doing what it does, going all over the place, there's an algorithm that's trading this particular index, moving money between the S&P and bonds. And since we have some bond exposure, it's not a full-blown S&P index. Since we have bond exposure, you can actually get higher caps on this blended index than you can get on just a straight S&P. And so if you look at index universal life insurance policies today, you'll see a lot of these companies moving towards these blended hybrid options where you have some S&P exposure, some Dow exposure, some bond exposure, maybe even some international exposure. The reason they're doing that is because, again, the company, assuming that they're a reputable company, they are spending the exact same amount of money on every single index that they purchase. It is the fixed rate that you have to choose from. If you choose to not take advantage of the fixed rate, they take whatever it was they were already going to pay you and they go hedge with it based on what you want. And so since they want you to win, they want you invested in some options that have a good upside, but also have the ability to actually achieve the upside. You know, this ag index has a good upside, but it has no ability to actually achieve the upside. It's wasted upside, and they don't want that. They want you to win. And that's why they're moving towards these blended index options that have higher caps. And so if you look at companies, so for instance, Allianz has this, AIG has this, Symetra has this, I think even North American has this. I believe that Minnesota Life, which is now Securian, has this. Even companies that I don't like, they have these options. And the reason that they have these options is because it's the best way to blend higher upside with higher caps, higher potential upside and higher caps. And so that brings me to where I want to close, which is caps going up and down. Again, caps will go up. Caps will go down. Rates will go up. Rates will go down. The reason that rates go up and go down is because we have this giant general portfolio of the insurance company, and that portfolio is invested in bonds. Those bonds are held to maturity, and you got 15, 20, 30 years of investments in these bonds inside this general portfolio. And that general portfolio kicks out a return. Right now we're looking at 4 to 5%. It's about the range. As interest rates are low, and we have thousands upon thousands upon thousands and thousands and thousands into infinity of policyholders paying their annual premiums into the general portfolio who's investing in bonds. They have to invest in bonds at today's rates, and today's rates are lower. And as today's rates stay low, the company has less dollars to spend, which is why they're trying to get more creative with some of their index options. As interest rates normalize, which I expect that they will, this is a long-term contract, I should say. If you're in an index universal life insurance policy for a short-term play, let's say that you're trying to save up to buy a house and you need a down payment in 3 years, 4 years, 5 years, you're in the wrong vehicle. I hate to break that to you, but you're in the wrong vehicle. These are terrible short-term vehicles. They are exceptional long-term vehicles. They are wonderful long-term tax-efficient income vehicles, but they're terrible short-term vehicles. And I say all that because long-term, I think that interest rates are on the rise. Long-term. Short-term to medium-term, who knows, right? But long-term, interest rates will normalize. They will go back up. And as interest rates normalize and go back up, and as these premiums continue to get paid, now all of a sudden, rates have gone up 5, 6, 7, 8 years down the road, and new money's being added at higher rates, and all of a sudden the general portfolio starts to go higher. And when the general portfolio starts to go higher, what you end up seeing is instead of a 4% fixed rate, now maybe we have a 5% fixed rate. And if you have a 5% fixed rate, now all of a sudden your caps on your indexes are higher because the company has more money to spend, and they are passing those costs on to you because they're simply perfectly hedging the contract, and they don't care which one you choose. In fact, they want you to choose the index that generates the highest return. So I know that we've kind of been all over the place today, Physically for me, I'm in my office versus the studio, and we've talked about caps, we've talked about rates, we've talked about how the companies hedge these index options. But I'm doing this video just because as we sit in a low interest rate environment in the short term, you should expect caps to maybe eke down a point or two. Long term though, I don't want you to be worried about that. Long term, with interest rates ultimately on the rise, when they do normalize and get back to where they should be, in the medium to long term, these policies will perform better than the way that we're illustrating them right now, simply because the companies will have more money to spend. So hopefully that's been helpful. Let me know if you have any specific questions about caps and rates or how these companies hedge. I believe I've done a video about hedging before. You can check that out on my channel. As always, let me know what else you want us to tackle on this channel. You know, we're always looking for different ideas or things that may seem complicated that we can dive into and try to explain in simple, easy detail. And I know that this one was a little bit more technical than usual. So hopefully it all came through loud and clear. But if you haven't already done so, please like this video, subscribe to this channel. That way you can stay up to date on all the future videos that we put out, which are typically on Thursdays. And if you have any specific questions for me, you can go to our website, leveragedwm.com/contact-us, and you can check out how you can get in contact with us by either booking a meeting or just sending us a message. But hopefully this video finds you well, and take care. Talk to you soon.